Hello everyone. So, I welcome you to the lecture on international business. So, today we will be continuing from our last lecture where we had stopped, where we were discussing about foreign trade promotion measures, and here we had discussed largely about what is trade promotion and what is its role in the development of a country, right, on the economic perspective. Then in the last lecture we also discussed about the trade regulations, and it is issued by the Commerce Ministry. We had discussed that. Then we also discussed about the major destinations for export and import of for Indian exporters and Indian exporters, and we discussed that there are around several countries to which India exports a lot of commodities and services, and also imports largely from especially in the petrochemical and other sectors, right. So, from there we also discussed about how you can start and somebody can start an export import business, and then we talked about the difficulties in exporting, and finally we talked about the we had started with the schemes, right. What are the schemes that the government has has initiated which will help in the export import businesses, right. So, we will continue from there. So, let us talk let us start with the definition of trade promotion again. So, as you understand, trade promotion is an umbrella term for economic policies and developmental interventions and private initiatives which is aimed to improve the trade performance of a country, right. So, it may be within a region or within the country or among a few countries, right, or a group of countries involved in an economic trade area. So, for example, some of the major companies I had discussed is like for example, Tata's, Reliance, BHEL, JSW Steel, right. Then there are large number of companies which are involved in exporting of goods, right, from India, and the exporting of goods is highly essential because we earn foreign reserves through that, we are foreign exchange through that, right. So, it becomes very important. So, then we talked about some of the schemes that the government has brought in recently and since some year, right, and to facilitate this export import business. So, various trade promotional measures and schemes are available for business firms to facilitate their export and import operations announced by the government in its export import policy. So, the government in its export import policy has brought in several schemes. So, in the last class we had discussed about these three schemes: the duty drawback scheme, export manufacturing under bond scheme, and the advanced license scheme, right. Now, we will continue from the fourth one. So, the fourth one, which is the export of services, right. So, as you know, services can be defined generally in terms of marketing as something which is intangible, or something which is which does not have a which is not tangible basically largely, right. So, services include all the 161 tradable services, for example, like accountancy services, legal services, tourism, health and social services, transport, education and so on, which is covered under the General Agreement on Trade in Services, right. So, we say GATS, GATS. So, where payment for such services is received in free foreign exchange, right. So, exports of services is especially very important for India, right. India has been one of the major contributors to the GDP has been India's service sector, right. So, service sectors are required. How one goes about? Service sectors are required to register themselves with the Federation of Indian Exporters organization. So, this is an organization which is the premier organization, and it represents the Indian exporters it helps in promoting the Indian exporters in the world market, right. However, software exporters, there is a special registration process. They have to register themselves with the Electronic and Software Export Promotion Council, okay. Because software, although it is one of those services which has a significant presence in among the services. As you can see, the IT industry in India is a key part of the country's economy. In 2017, its various subsectors represented almost 8% of the nation's GDP. In 2019, this industry generated an annual revenue close to $180 billion US, which was a significant increase from the generated revenue a decade back, right. So, a majority of this revenue was generated in exports right, while domestic revenue total to less than 50 billion, right, US dollars for the mentioned period. So, that means that our export in services is a very significant factor for growth, and it takes a large size in the entire business. The next part of the schemes in which the government has brought in is relating to the export finance, right. So, as you know, credit and finance, right, are the lifeblood of business. So, the the most important part for any business is that it has to have the right finance, right. So, if credit facilities or financing facilities are not available, businesses would not grow well. So, export financing is loans made for the shipping of products outside a country. Now, financial assistance is extended by the banks to the exporters at pre-shipment and post-shipment stages. So, what happens? So, in order to encourage and help the business, the government has initiated schemes which helps in financing the exporters and or even for import purpose, right. So, what it does basically, it says it is through the banks, right, the financial assistance is extended to the exporters, and at what stages? At the pre-shipment and post-shipment stages. Now, what is a pre-shipment and a post-shipment stage? Let us see. So, the pre-shipment stage, also called as packing credit, means any loan or advance granted or any other credit provided by a bank to an exporter for financing the purchase, processing, manufacturing or packing of goods prior to the shipment. That means, anything before the final shipment is done. So, for that, or for example, in another way you can understand it as the working capital expenses towards rendering of services on the basis of a letter of credit opened in his favor or in favor of some other person by an overseas buyer, right. So, this is basically when you talk about pre-shipment, for all the working capital expenses and all, the banks give the finance, right. Then in post shipment finance, what happens? Here it refers to the credit extended to the exporters after the shipment of. So, there is a shipment. So, pre-shipment and post-shipment, after the shipment, right, of goods for the working capital requirement. Now, post-shipment finance is generally provided in order to bridge the gap between shipment of goods and the realization of the proceeds. So, there is a gap in which the exporter exports and he receives the proceeds. So, in between this time, so there is a requirement of finance. So, for this reason, the banks or the government has made such schemes, right. The finance is available at concessional rates of interest to the exporters. So, the in order to encourage the exporters to do more business, the government has made this scheme and tried to make it lucrative by offering them at the finance at a lower interest rates. Okay. Now, some of the institutions which are involved in export finance are, for example, there are number of institutes. For some of them are, for example, the Exim Bank, we say Export Import Bank, the commercial banks, both nationalized and non-nationalized, development banks such as IDBI, ICICI, etc., SIDBI, Small Industries Development Bank of India, state financial corporations, right, National Small Industries Corporation, Export Credit Guarantee Corporation. So, these are some of the institutions which are there in order to lend finance to the exporter, so that it could easily carry on its activity and make its export in a much better way, right. Example, if the export is made to USA against the letter of credit of the importer, let us say. So, there is an importer and so against the letter of credit of the importer, the exporter's bank will purchase the bill, right, and pay the full value to the exporter, right. Here the bank gains as the value of currency is bound to go up, since it belongs to a developed country and the entire risk of the bill is borne by the bank. So, it is not necessary it will happen all the time, but there could be times when it might not happen also. So, but then this risk is borne by the bank, right. Example 2, if you see, if the export is made to suppose Egypt or Philippines, the bill will be discounted for 60 or 70% of the value, as they both belong to developing countries. Now, that is very interesting. You see, again if you see what is happening, if the export is made to a developed country. So, this is a developed country USA. So, in that case the the bank gives the full value, right, but when it is going to a country which is developing or less developed. So, in that case he will the bank will be discounted only to 60 to 70%. So that if there is any risk which is possibly which might be there, so that will not be much and it will be neutralized. If the export is made to countries in Africa such as Namibia, Rwanda, Somalia, etc., then what does the what is the process? The bill will be collected and paid to the exporter after 3 to 6 months, since the importing country happens to be a poor country. So, these are some of the ways how the banks operate and try to nullify the risks associated with these different countries. Okay. Another important measure which the government initiated is the export promotion capital goods. So, we say EPCG, right. So, what is it? It is an initiative by the government of India and is a part of the foreign trade policy 1520. It was first operationalized on 1st April 2015. So, April this is the Fool's Day, right. So, 1st April. So, EPCG scheme helps to facilitate import of capital goods into India for producing quality goods and services. So, for suppose for example, to make some some items you need to import certain capital goods, right. So, for that you this EPCG scheme helps in this process, right, and to enhance finally India's export competitiveness. So, this is one big important role of this EPCG. It also allows for the import of capital goods used in pre-production, production and post-production at zero customs duty. Okay. This schemes allows for upgradation of technology in the exports industry, right. Second hand goods of any nature will not be permitted under the EPCG scheme. So, these are some of the guidelines. The importer of capital goods, so this scheme is largely related to the capital goods only. The importer of capital goods must file the application with necessary supporting documents with the Director General of Foreign Trade. So, we have already learnt about the Director General of Foreign Trade in the last lecture. So, it is a very important premium body which is responsible for the foreign trade policies and basically the businesses, export import business. The main objective of this scheme is to encourage the import of capital goods for export production. So, this for whenever you require certain capital goods or items which are important for the production of export oriented goods, in that case the EPCG comes into plays its role and facilitates the entire process. The following types of goods, capital goods can be imported into India at zero customs duty under this scheme. What are they? Plant, machinery, equipment or accessories required for manufacture or production either directly or indirectly of goods or for rendering services, including those required for replacement, modernization, technological upgradation. So, as we said, the EPCG is also responsible for upgradation of the technology, right. Packaging machinery and equipment, refrigeration equipment, power generating sets, machine tools, equipment and instruments for testing, research and development, quality and pollution control. Then capital goods used in manufacturing, mining, agriculture, aquaculture, animal husbandry, floriculture, horticulture, poultry, sericulture, viticulture as well as those used in the services sector, and finally computer software systems. So, the EPCG has a very big role to play because it helps in the import of the capital goods and upgradation of the capital goods also of the technologies also. So, it plays a very vital role in the entire export sector. The next important body you can say or scheme that the government started is the export processing zones, EPZs. So, what is this export processing zone? Export processing zone is a specific type of free trade zone, FTZ, right, set up generally in developing countries by their governments to import plant, machinery, equipment and material for the manufacturing of exported goods without the payment of duty, right. The basic objective is to enhance foreign exchange earnings, develop export oriented industries, generate employment opportunities and promote industrial and commercial exports. So, export processing zones are industrial estates. You must have heard of industrial estates in your localities and regions where you are staying. So, these come under the EPZs, right, situated near seaports or airport. I come from a place where I am close, I stay close to an seaport, right, that is a we have a port out there and we have our own industrial estate. So, these are basically the zones which help in the entire process of business. They are intended to provide an internationally competitive duty free environment for export production at low cost, right. This enables the product of EPZs to be competitive both quality wise and price wise, because then the transportation cost and other costs come down. So, in terms of price they become very competitive, right. EPZs have been set up at various places in India like Kandla in Gujarat, Santa Cruz in Mumbai, Falta in West Bengal, Noida, Uttar Pradesh, Cochin in Kerala, Chennai in Tamil Nadu, Visakhapatnam, Andhra Pradesh, right. Santa Cruz basically is exclusively meant for electronic goods and gem and jewellery items. All other EPZs deal with different kinds of multifarious items. Okay. Then we come to the under this only EPZs we have something called the special economic zones, right. So, what is this special economic zone? It is a specially designed geographical area, right, for trade, economic activity, production and other commercial activities. So, what is basically this? What is it is a geographical area which is done with this purpose, right. So, what has happened, let us see. While correcting the shortcomings, so EPZ model has some shortcomings, right. So, for example, like the multiplicity of controls and clearances, the absence of world class infrastructure and an unstable fiscal regime, right. So, these were some of the shortcomings of the EPZ model. So, in this SEZs these were corrected. So, some new features were incorporated in the SEZs policy announced in April 2000. The EPZs have converted to SEZs which are more advanced form of export processing zones. So, the EPZs only have been rechristened now today as special economic zones. These are free from all rules and regulations governing import and export units except relating to labor and banking. Okay. SEZs play a key role in the rapid economic development of a country. So, you must have seen that governments lay a lot of emphasis on the special economic zones, right. So, benefits of operating within an SEZ include tax breaks for business owners and independence. The main facilities, some of the main facilities under the SEZ Act are import and export of all goods is freely allowed without payment of any duties or taxes. So, you do not have to pay, right. Exemption from Income Tax Act as well as industrial licensing for SSI items, right. 100% FDI is permitted in the units through the domestic route, right. There is no interference from custom authorities inside the zone. The supplies made to SEZ are treated as exports, right. The units are exempted from payment of CST as well as service tax, right. So, these are some major benefits, right, and these benefits is what makes it very attractive. Okay. Just some of the success stories, for example, Nokia special economic zone in Tamil Nadu, especially for telecom equipments, right. Mahindra City SEZ in Tamil Nadu again for apparels and fashion accessories, IT, hardware, auto ancillary. Wipro Limited, Andhra Pradesh, IT. Biocon Limited for biotech. Reliance Jamnagar Refinery Infrastructure Limited, multi-product, it is a multi-product SEZ. Maharashtra Airport Development Corporation for multi-product. Hyderabad Gems Limited, gems and jewellery. So, Mundra Port for multi-product again. So, these are some of the success stories under SEZ categories. Okay. So, the question comes is who can set up SEZs? Can foreign companies set up SEZs? So, as you saw some of the names, for example, we said Biocon, Reliance, Wipro, Mahindra, Nokia. So, the name of the companies are associated, right. So, that means can anybody set up? So, the question here is can foreign companies set up SEZs? Any private, public, joint sector or state government or its agencies can set up an SEZ. So, the SEZ, the good thing is there is a public private partnership basically, right. A foreign agency also can set up SEZs in India, right. Who monitors its functioning? the performance of the SEZ units are monitored by the unit approval committee consisting of a development commissioner, custom and representative of state government on an annual basis. Okay. Will it be possible to supply to other units in the SEZ, right, within the SEZ or something? Yes, inter unit sales are permitted as per the SEZ policy. A buyer procuring from another unit pays in foreign exchange. So, these are some of the questions which are connected with the SEZs, which may be now clear to you. The next thing that comes in this export oriented schemes and measures is the 100% export oriented units or EOUs, export oriented units. Now, what are these? These were introduced in the early 1981 and is complementary to the export processing zones scheme. The EOU is governed by the provisions of this EXIM policy, right. So, what is its main objective? To increase exports, earn foreign exchange to the country, transfer of latest technologies and generate additional employment, right. What are the facilities under this scheme, under this 100% export oriented units? The facilities are, the units can import or export any goods except the ones which are under the prohibited categories, right. The units are exempted from payment of income tax. So, some of the things you can see with the the other schemes also, there are some common things, right. Exempted from industrial licensing, which is a prerequisite for manufacture of items reserved for the small scale industries, the SSIs, right. Such units are allowed to retain 100% of its export earnings in their exchange earners foreign currency. Okay. 100% FDI investment is permitted in such units through the automatic route, right. The units are also exempted from payment of central excise duty on the goods procured from domestic tariff area. So, these are some of the facilities or the benefits of the export oriented units. Some other new schemes have come in recently and we will talk about this also, some new export promotional schemes. The Ministry of Commerce has implemented the following export promotion measures at micro level. Now, this is important to resolve the short term problems faced by the trade and industry related to the external sector. So, these schemes are like, for example, the ASIDE scheme, the TIES, MAI and MDA scheme, right. So, let us understand each one of them, what these schemes are, because they are working at the micro level, why the government had thought of it, because obviously to take care of the short term the short term problems, right. What is this ASIDE scheme? First one. So, as the name suggests, assistance to states for development of export infrastructure and allied activities. So, the full form is assistance to states for development of export infrastructure and allied activities. The scheme was launched by the Department of Commerce on 2002 March, 13th March 2002. What is the objective of this scheme? To involve the states in the growth of export by providing incentive linked assistance, right. So, there are incentives attached, so that state governments would try to be more oriented and progressive towards or try to progress in this export businesses, right, and to create appropriate infrastructure for the development and growth of exports. So, as we have seen, there are a lot of things which are required for the development of exports. For example, you need right infrastructure, you need to settle down some of the policies or remove some of the or make some of the policies less difficult for the clearance policies and all these things. So, to do all these things, the government has started such schemes, right. This scheme is a centrally sponsored plan scheme in which outlay is provided for development of export infrastructure that is distributed among the states on the basis of the state's export performance in the last year, previous year, right. And how is the funds allocated? 80% state government and 20% central government. So, the 80% of the fund has to come from the state governments and 20% will be given by the central government. State allocation made in two branches of 50% each on the basis of export performance of each state on the twin area of gross exports and the rate of growth of exports. So, the ASIDE scheme is largely done for encouraging the states to participate in development of exports and develop accordingly the infrastructure. The ASIDE scheme was launched after subsuming the following 4 schemes. So, these 4 schemes that were merged to make this ASIDE scheme. Export Promotional Industrial Park Scheme, right, EPIB, IP, Critical Infrastructure Balancing Scheme, CIB, Export Promotion Zone Scheme, EPZ, Export Development Fund for Northeast and Sikkim, EDF, right. The state shall utilize this amount for whatever the government gives for developing infrastructure such as roads connecting to the production centers, development of minor ports, creation of new state level export promotional industrial parks, etc. Okay. Some of the success stories in India are, for example, Maniram Diwan Trade Center in Guwahati, Land Custom Station and Trade Center at More on the Myanmar Manipur trade route, strengthening of Institute of Auto Parts and Hand Tools Technology, Ludhiana, International Flower Auction Yard, Bangalore, India Export Center and Mart, Greater Noida, right. The next after the ASIDE is the Trade Infrastructure for Export Scheme, TIES, right. So, the Commerce Ministry launched the Trade Infrastructure for Export Scheme on June 2018 to create appropriate infrastructure for development and growth of exports through engagement of central and state agencies. The total outlay was 600 crore and the cost of the projects under TIES are equally shared. There it was 80-20 in ASIDE, here it is equally shared between the central and the state government. What is the objective of this? The objective is to enhance export competitiveness by bridging the gap in export infrastructure, including states to take up more export oriented projects, including those required for addressing quality and certification concerns. So, these concerns if it would be removed or addressed, then export competency would be enhanced obviously. It helps in setting up land custom stations, quality testing and certification labs, cold chains, trade promotion center, dry ports, export warehousing and packaging facilities, etc. right. Some of the implementing agencies of these schemes include Karnataka Fisheries Development Corporation Limited, Vishweshwara Rai Trade Promotion Center, Airport Authority of India, Coffee Board, Export Inspection Council and Andhra Pradesh Medtech Zone, right. So, these are some of the schemes and its objective and the benefits we have seen. Now, we will go into the next one which is called MAI. So, Market Access Initiative. The Market Access Initiative scheme is intended to provide financial assistance for medium term export promotion, right, with a sharp focus on a country and product concept. This was launched in 2003 with an objective to work as a catalyst to promote India's export on a sustained basis, right. The financial assistance is available for export promotion councils, industry and trade associations, agencies of the state government, Indian commercial missions abroad and other eligible entities for enhancement of export through assessing the new markets or through increasing the share in the existing market. So, it is basically a market access initiative, an initiative to get into new markets or even wherever you are to encourage or grow your market share. Each of these export promotion activities can receive financial assistance from the government ranging from 25% to 100% of the total cost depending on the activity. Some of the following activities which will be eligible for financial assistance under this scheme are marketing projects abroad, brand promotion, publicity campaigns, sales promotional campaigns, setting up of showroom or warehouse, support of statutory compliances, registration charges for pharmaceuticals, participation in international trade fairs, testing charges for engineering products. So, this is basically done to enter into the foreign market and to promote the brands and try to increase the market share in the other markets, right. The last in this scheme, the fourth one is the market development assistance. So, this scheme is intended to provide financial assistance for a range of export promotional activities implemented by export promotion councils, industry and trade associations on a regular basis every year. Okay. The MDA scheme is administered by the Department of Commerce, Ministry of Commerce and Government of India, right. As per the revised MDA guidelines with effect from 1st April 2004, assistance under MDA is available for all exporters with annual export turnover up to rupees 5 crores. So, all who have a export up to 5 crores, they can avail this benefit. These include participation in trade fairs and buyer seller meets abroad or in India. It was like more like the MAI, right. So, the scheme is operational through the Department of Commerce to support the following activities. What are they? So, this are some of the activities are, for example, include participation in trade fairs and buyer seller meets, assist exporters for export promotion activities abroad, assist export promotion councils to undertake export promotion activities for their commodities, assist approved organizations or trade bodies in undertaking exclusive non-recurring innovative activities connected with export promotion efforts for their members, and finally, assist focus export promotion programs in specific regions like the Latin American, Caribbean region, Africa, Commonwealth states, Asia, etc. Right. So, so these are some of the these are the 4 policies as started by the government recently, and in fact, it has been there for some time, but the government has been trying to develop this more. The present government has been trying to focus more on them and trying to although they are there from since 2004, 2003, but the point is the government has been trying to give more emphasis on this since recent times, so that our exposure in the foreign markets is more, and we will have a foothold in this other market in a much better way, right. So, this is all we have discussed today. I will wind up the lecture here, and we will continue from the next part, which is organizations in foreign trade regulations and all. So, foreign trade in the business of foreign trade, what are the different organizations in India which are assisting in this. So, we will discuss about it in the next class. So, thank you so much.